Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Nick McLean. He is the co-founder and partner of 4Pillar, a private equity firm that partners with entrepreneurs and investors to purchase and operate lower middle market businesses ranging from 20 million to 250 million in sales, with an untapped potential for growth. 4Pillars isn't your typical private equity firm, at least partly due to their relationship first approach. They aren't about financially engineering or extreme cost cutting, but instead using their experience as entrepreneurs to help grow companies in terms of revenue and employees. Nick, you're the first, as we were talking a little bit ahead of the show, private equity guy that I've had on The Wealth Flow. And so very interested to take a deep dive into this avenue of really being able to turn some businesses around.
Well, it's a really exciting topic to me, so hopefully your audience will find it at least half as exciting as me, maybe.
I'm sure they will. Why don't we start with really kind of your background? I always like to go way back, Nick, to where you grew up and what eventually led you into private equities.
Yeah, that's great. I mean, I can go as far back as you'd like. I just hope I don't put your viewers to sleep, but, hopefully that won't be an issue here. I grew up in a town just north of Kansas City called St. Joseph, Missouri. It was a 4 high school town, about 80,000 people. Good place to raise a family. In high school, ultimately went down, working with my guidance counselor, actually chose a major in industrial engineering. That was never a topic that anybody ever talked about in high school, but here my guidance counselor is suggesting it. And I said, all right, that sounds interesting. I'll do it. Well, I'll tell you what, it was actually a really good fit for me. Industrial engineering is about making processes more efficient, standardizing processes, those types of concepts. And I really enjoy that type of work. Through college, my expectation was that, or not expectation, but my goals were to ultimately run a business, whether that was the CEO of a big company or, owning a company and running it as well. I wasn't really sure, but I definitely wanted to be in a position where even if I wasn't maybe calling all the shots, I at least had a seat at the table. And, my view at the time was the operations path is the way to get to that top seat, if you will. Really tried to structure my education and early career based off of that. So after graduating from the University of Missouri with a degree in industrial engineering, I went to work for Deloitte Consulting for 2 to 3 years in operations-related consulting. Again, process improvement, process standardization, implementing some technology tools, et cetera, et cetera. Always knew that I wanted to go back and get an MBA. And after a few years in consulting, I was going down a path of increasing specialization as opposed to, broadening my horizons, so to speak. So thought that was a good time. Going into grad school, thought afterwards I'd get a job at a Fortune 500 company. work there for 20 or 30 years, rise through the ranks and, retire and get the gold watch, or get the gold watch and then retire, whatever the chronology is. However, I didn't realize in grad school, but got exposed to lower middle market and middle market companies, through various experiences there, got exposed to investment banking, private equity, and realized that maybe the huge corporate conglomerates were not the right fit for me. So really it was quite a big pivot in grad school. So my first job out of grad school was a investment banking role at a boutique investment bank in the St. Louis area. Worked there for about a year and a half. After there, really rotated through a variety of different roles in and around M&A, private equity, investment banking. After one or two jobs of liking the job at the beginning, but then after 6 months, a year, 18 months, not only starting to dislike the job, but really actually hate the job. 1 to 2 of those, you can pin them on bad luck. But after like 3 or 4 or 5, you kind of got to start looking at yourself in the mirror. And what I realized is that I was an entrepreneur, just not the entrepreneur that I had always thought of. I had always thought of an entrepreneur being somebody that had an idea for a better mousetrap or a killer app. However, there's a term that hadn't been popularized, back then, but the term's called entrepreneurship through acquisition, and that's the flavor of entrepreneurism that really resonates with me. Through those roles, as I mentioned, I wanted a seat at the table, and after realizing that all those failures, if you will, that if I wanted a seat at the table, I was going to have to build the seat, I was going to have to build the table. And that's why I launched 4 Pillars in 2014, 2015 timeframe with my partner, Thomas Sanford. So I'll pause there to see if you have any questions up until that point.
Yeah. So prior to that point, you were in acquisitions. You were buying other businesses. And you found that you just enjoyed that piece of the puzzle a lot better than maybe having to start it from scratch. What were some of the things that you like better about acquisitions?
Well, I mean, it's a very good question. And what I will tell you is that at that time, I really didn't think it was purely about the acquisitions. I didn't think it was purely about the deal. It was more the types of companies that we were working with, where if you wanted to make a decision, if you had the approval of your boss, who might have been, the president of the company, you could go do it. I've also worked at, big company like Deloitte Consulting. It's a fairly large company with, offices all over the world. Worked at other big companies like Intel, a lot of bureaucracy. You want to do something done, well, you are going to have to fight hard and over a period of months to try and get any sort of change through. Just not the same in small businesses. I mean, small businesses don't have the luxury of that bureaucracy because of their size and their need to be nimble and whatnot. And so through this period, it was still more, my thinking was still more along the lines of, I just want to work with small businesses because those are the types of businesses where you can really make an impact and help the business grow. However, my partner and I's early goals were to buy 2 businesses, one for me to run and one for him to run. After I was running the first business for about a year to year and a half, there's a recurring theme here about, me working in a job for a year to year and a half. But after that time frame, I realized that it wasn't just that I wanted to be the president of any sort of company. I really wanted to work in deals. I wanted to run a private equity firm. And so we shifted our focus to just finding those 2 companies for my partner and myself to run, to really becoming what's called an independent sponsor, which is a private equity firm that doesn't have a committed pool of capital. Instead, we raise capital on a deal-by-deal basis.
Okay. So those are for individual businesses that you find, then you raise capital for them, and the investors are essentially attached to that specific deal.
That's exactly right. Yeah, we will have common investors on different deals if the additional deals line up very well with their investment parameters, if you will. But generally speaking, on each platform deal, as we call it, we will have a unique investor pool for that deal.
Okay. That's neat. And what type of businesses have you been exposed to? Which ones do you see opportunity in?
Well, I see opportunity in all of them. I mean, we're definitely our mindset is more let's make the pie bigger as opposed to let's make our piece of the pie bigger. If you understand what I mean by that, so we really see opportunity in a lot of different companies, and just furthering that a little. We're not the type that has a checklist, and if you don't check off every one of these boxes, conversation over. Like we're really trying to we take each whenever we're talking to a business owner, and maybe there's some noise or some hair on the deal, as we like to say it sometime. We're not looking to say no. We're trying to we're taking the mindset that this could be a diamond in the rough, and we want to prove the thesis that yes, in fact, this is a diamond in the rough, and this could be a great opportunity. Let's figure out how to solve some of these problems, if you will, and if we can, then it's going to be a home run for everyone. In terms of specific industries, though, if you look at our portfolio, it's definitely overweight in manufacturing, and a big reason for that is, well, two big reasons. One is my background, just being in industrial engineering, which was a lot of manufacturing, but also, I mean, we're still in Kansas City, and I don't know if you've been to Kansas City before, but you can't walk too far in Kansas City without running into a manufacturing firm. So, just in our area of the country, just a lot of manufacturing firms.
Okay. And your background, and everything from your degree on up, where you're finding efficiencies, that kind of thing. Is that what you're looking for when you take on one of these businesses, looking at it and saying, wow, they could take it to the next level if they did X, or whatever it may be?
Well, I will tell you that was a very transformative part of my career. During that early part, I really did think operations and operational efficiency was a huge driver in really transforming the company, or at least taking the company from X to Y. However, in one of my roles, it was with a private equity backed manufacturer. I did a lot of different things. I mean, I was even like the HR person for 2 or 3 months while we found a new HR person. But another one of my roles was business development. And whenever I first got there, though, what I was doing was, again, the process improvement. And we had a couple process improvement projects, and they were great. They turned out really well. We reduced inventory, increased throughput. They were a success by all measures. But when you look at the financial statements, were you really able to tell the impact of those two successful projects? I mean, not really, at least not in my opinion. However, in my business development role, we helped land a customer that increased the company-wide revenues by 10 to 20%. And I was just looking at all the effort that went into the operational efficiency projects, the lean, the Kaizen events, if you will, versus the work that went into the business development efforts and the resulting impacts. And it really changed my worldview. I stopped thinking that the path to ultimate company success is operational efficiency, and really realized that if you really want to have a big impact on the company, look at the top line. I mean, obviously, you can't pursue top line at all costs without giving any consideration to costs. But
Right.
in terms of picking one to focus on, we're going to focus on the levers that we can pull in order to drive top line growth, with the second focus being a look at how we can improve operationally.
Okay. Now that makes sense. It seems like that would be the one that would be the bigger of the levers to be able to pull. Give us maybe an example of that. Like, what's one of the things that you've done with a company where you say, here's maybe another avenue or of revenue stream that we can, incorporate, or what are some examples of some of the things that you've done?
Yeah, I mean, I'll give you one example. If you want more, happy to give you more. But I can point to the steel fabrication company that was our first acquisition. Whenever we were talking to the sellers, we asked them why they didn't pursue this line of business. Oh, it's too costly. We've always been a somewhat capital constrained organization, and oh no, we just can't compete in that line of business. Well, for the first period of time, believe them and realize that, yeah, I mean, we weren't in a position to drop $1 million, $2 million on equipment either. So again, somewhat believed or bought into what the former owners of the business were telling us. However, to fill in between our bigger projects, sometimes we do projects in this other area, and we actually did okay on them. Now they were small projects, not the big ones, but still we thought, okay, well, we should test this thesis a little bit more. Like what would it take in order to go after this new segment of customers? Well, we started looking at used equipment, and it wasn't millions of dollars. We bought 2 or 3 machines that totaled, I think, was $125,000. We purchased those machines. Took a long time to get them up and running because of there were some always issues whenever you're installing equipment, especially used equipment. Ultimately, got it up and running. I think it will be 2 or 3 years this August, and I think the equipment paid for itself within the first six months. So this was an example of where there was this entrenched belief that we couldn't go after these customers because it was so capital intensive or this and that. We tested the waters, found a low-cost solution to not really dip our toes into the water, but not commit to, again, that $1 million or $2 million spin. And it's been a huge success for us. We don't need the super fancy, newest equipment. It's kind of like buying a new car versus a used car, in our opinion. And it's just been a great success story for the company.
Yeah. And how long are these normal? So when you go in and partner with a business by trying to grow it, and you obviously have investors that are tied up in this with you and kind of taking that ride alongside with you. Tell me, I guess, a little bit about how does it work. How does the investment itself work? Is it upon the sale of the business at some point that the investors get paid back? Do they share in any kind of distributions, or what does that look like, Nick?
Yeah, absolutely. Good question. So what I would tell you is that typically speaking, on our deals, whenever we're dealing with a seller that has been involved in the business up until the point of the sale, we would typically like to have some deferred or contingent consideration for that business owner that does not come at close. It comes, in 1 year, 2 years, 3 years, whatever the case may be. Because, our view is that, if they were instrumental in the business prior to us buying it, then we probably want to rely on that expertise and experience, at least in the early period of our investment, post-close. And so in that way, we really feel like our incentives are aligned. From the investor standpoint, what we would typically say is that we would expect to exit the transaction in 3 to 7 years. And I know whenever I say that, some people are thinking, oh my gosh, that is just too much churn for employees. It creates uncertainty, risk, and whatnot. But our mindset's a little bit different. I mean, I think 3 years, 3 years would be quick for us, but 5 to 7 years actually isn't a terrible time period because me personally, I wouldn't want any of our CEOs to be in place much longer than 5 to 7 years. It's not that they're not qualified, but in our view, doubling a company from 20 million of revenue to 40 million of revenue is usually a little bit different than taking it from 40 million to 50. And a lot of times that's what happens is the company gets to the point where it needs a different leader, and oftentimes that coincides nicely with needing a different capital provider. Now, it's not always like, okay, 5-year time frame, we need a new CEO, we're going to have all this transition. But it's just I just make that point to show that a lot of times there are reasons why not having the same person or the same group in for 10 or 20 years is actually going to result in greater growth, as opposed to what we have seen is a bit of stagnation after you achieve that initial round of success, if you will.
Yeah. Okay. So you can recognize that initial round and then turn around and sell it. When you're buying these, you'd mentioned kind of keeping the prior owner, involved for X period of time, which makes total sense. Plus then it sort of allows you to troubleshoot some of the things as well. I mean, versus them just be done at closing and all of a sudden the wheels start falling off. So are you typically buying these from like a mom and pop operator, and then who, after you're done, kind of growing that revenues, who are you selling it to at that point? Is it another private equity firm, or what does that look like?
Yeah, good question. So our preferred seller would be a founder owned or family run business. Second, third. I mean, I guess first generation as well. But those are typically the types of folks we connect with the most, just because they tend to be fairly entrepreneurial. And like I said, like we're pretty entrepreneurial ourselves. So those are the two classes of buyers that we feel like we work best together with. In terms of the exit, when that's 5 or so years down the road, it's very likely that it would either be to another private equity firm that's larger. They've seen the success that we've had and think that it could work well with one of their existing portfolio companies, or could be a new platform investment for their firm. Or another common exit would be to sell to a strategic, which would be just a larger competitor that wouldn't be owned by private equity, that's in a related field or somewhat related due to horizontal or vertical integration.
Okay. No, that makes sense. And what are some of the things you mentioned? Adding different streams of income, but how are some of the ways that you're growing these businesses?
Well, first off, what I'll tell you is this might sound trite, but our what we feel like is the number one predictor of whether or not the company will actually achieve growth is if that company has growth as one of their goals. So often we're working with business owners that, I mean, they've done a great job growing the business, and it's throwing off $3, $4, $5 million of EBITDA or cash flow a year. And I mean, there are very few people in the world who wouldn't feel like doing that for a few years in a row would be all the money they could need, more than enough money that they could ever spend in a lifetime. Plus for their heirs and whatnot. And so what we found is that there are a lot of business owners that get to a point where the growth isn't worth it to them anymore, either because it puts the core business at risk, because it requires a significant capital outlay, or because it requires too much of their time. They probably put their blood, sweat, and tears into the business for a period of time, and now the time comes for them to harvest. What is a very typical situation for us is to get in and learn that there's a potential to grow with certain customers or to pursue this market or that market that you have some visibility to. It's not like it doesn't feel like a crapshoot. It just feels like a logical continuation of where the business needs to go as it grows and evolves and gets to be a mature business. It's just that the current business owner hasn't wanted to do that because of the current risk profile or time horizon. Those are the opportunities that get us really excited because we're willing to take a little bit more risk. We're willing to put more capital at work, whether that's in the form of equipment or personnel or marketing and advertising and whatnot, to go after these different areas of growth that are maybe going after a new customer, making an existing customer larger by offering a fuller suite of services or capabilities, or entering a market, maybe in Mexico or Canada or in Europe. There's really a wide variety of different growth opportunities. What I would tell you though is that we're not typically the ones bringing the ideas to start with. We're talking to the people on the team. They're the ones that know the business the best. And it's I mean, I would feel extremely egotistical to walk into a business owner and pretend like I had all these great growth ideas after only knowing his business for an hour or two. So our first starting point is we ask a lot of stupid questions about why, what's going on with this customer, what's going on with that customer. Have you pursued this this line of business? Can you add this service line to make it complementary to your existing service lines? That type of thing. And typically through that process, we identify a lot of opportunities, and there's the start of a renewed interest or a spark within the business owner. It's like, man, this is kind of exciting. Like nobody's shown this much passion about growing my business since I had that passion, several years ago. And it's just a different story because now that business owner can use his experience and expertise, but isn't the one that's footing 100% of the bill, isn't the one that's footing 100% of the risk.
Yeah, that makes sense. That's neat. So those are some of the things that you do. And what? So geographically, where are you investing? And I guess maybe A follow up to that would just be, how are you finding these businesses?
So we've looked at businesses, throughout the lower 48. My partner actually was born and spent the first, I don't know, 8 to 12 years of his life in Alaska. So I mean, we kind of looked at Alaska just because his brother is still there, but generally speaking, it's throughout the U.S. I mean, my partner, the second deal we purchased was in Portland, Oregon. He moved with his wife out to Portland, has been running that business ever since. We have a company, in my hometown, Kansas City, and then the other two operations are in Chicago and outside of Cleveland. So we're relatively geographically dispersed, and that's perfectly fine with us. Given the opportunity, the opportunities that need more handholding definitely need to be close to a major airport. But the ones that we feel like we're just supporting the management team, less of a concern as to where they're located.
Okay. And with those businesses, well, I guess first, how are you finding some of those businesses? What do you are you reaching out to the mom and pop operators? Do you have a team that's doing that, or you working through business brokers, or what? What's the method?
This is a question that gets asked of everyone. I mean, it's a good question, and it gets asked all the time because everybody's curious about it. I mean, really, we've tried a lot of different things. I mean, I've sent out physical mailers. We've done cold calling. We've done cold emailing, conferences, events, networking, working with business brokers, just looking at their sell side mandates. So, they have a client that's trying to sell and they market it to us. We've worked with investment bankers or business brokers where it's what's called a retained buy side search. So, I mean, throughout the years, I won't say we've tried everything, but we have tried a little bit of everything. And what I will tell you is that, really we just use different methods during different periods. So if we're super busy, like have a very full pipeline, we'll definitely dial back the cold calling just because that's a very time intensive activity. But still try to develop the pipeline in other ways. So, again, we'll use different methods depending on what's in the current pipeline, what we're trying to go after, et cetera, et cetera.
Okay. Makes sense. And are you finding that there's plenty of businesses out there that kind of could meet this criteria? The reason I ask, I hear oftentimes about whether calling it the silver tsunami, whatever it may be, but baby boomers that have built these amazing businesses, and they've gotten to that spot where, maybe they're ready to hand it off to a, son or a daughter. Maybe a son or a daughter doesn't have a whole lot of interest in doing that. And so then it's like, okay, what do I do with it now? Type of thing. But what are you finding out there in the marketplace?
So definitely see a lot of opportunities. I will also say that I will never say there are too many opportunities, because if there's the more opportunities you are, that just the more selective you get to be in terms of evaluating those different deals and whatnot.
Yeah.
But what I will tell you is, it's hard for people to let go. It really is. I was talking to a business owner that was in his early 80s, maybe even mid 80s. I think maybe 82 when we started, and by now he's 85. Still's not ready to call it quits. Can't, at that point, like his health isn't failing him, but he can't physically work a full day at work because his legs get, bothered or whatever. He was working with an investment banker. The investment banker really thought that we were a great potential buyer because of our background and experience, and our offer was very fair. And he just decided to take it off the market and didn't want to sell. And that's his right to do that. But that's something that we continue to face, and that folks are just not quite ready to hang it up. I think a big reason for that is just the uncertainty. These guys have been running these businesses for 20, 30, 40 years in some case. It's impossible not to say that that's part of your identity. And I get it. If you sell that business, it feels like you're cutting off part of your person or whatever. And I know there are other factors involved as well, but I mean, I get it. I mean, that it's not an easy decision to make. It's not an easy decision to follow through on. And we're encountering that on a variety of different deals. I mean, not all at the same time, but I think you get what I'm trying to say.
Yeah. And what about from a financing standpoint? Are you financing any of these, in any of the acquisition, or is it all investors' monies that's going in and basically paying cash for the business, or do you use some type of leverage?
It really just depends on the deal. We've done some deals where we have had leverage at close. We have had other deals where it was 100% equity at close. However, later on, we put some leverage on the business. Done a deal where it was one capital provider. They invested a mix of equity and debt, subordinated debt. It really just depends on how the investors want to structure their investment, and also what the debt markets are doing. So for example, if we can't get the terms on a senior piece of debt that we would want, then we'd probably try to increase the amount of equity that we invest in the deal, so that the debt is not too onerous, or too many covenants, or too high of an interest rate, that type of thing.
Okay. And with these, when you're structuring that, what is, I guess, as you're looking at these opportunities and you're building an opportunity for the investors, you said it's usually a 3 to 7 year hold on these, about somewhere in that range, and hopefully at that point you're growing. So do you bring in a management team that kind of takes it from there? I know you said you kind of retain some influence of the owner for a period of time. As you were saying, how some aren't ready to hang it up. I kind of think that surely in some of these cases there's been an owner that's been like, well, wait a minute, Nick, what are we doing here? What? I don't think we should go that direction. It's almost like you gotta, okay, you've done a great job of building it this far, but let us carry it from here. I don't know. What are some of your experiences from that standpoint?
Well, what I will tell you is that we go in, first off, let me say the perspectives, the mindsets of the management team is often different than the mindset, the perspective of the seller. So typically what we found is that the management team, is more flexible. They get excited about growth. Don't think of growth as only one dimensional or one potential path to go down. Again, it's more of, if we can get them excited, get their input, and use their input in formulating a growth plan, usually you're able to get the management team involved. The sellers are a different story, much to kind of what you hinted at there. What we've found, at least on our deals, and again, every deal is different. So you could talk to somebody else that's done 3 deals or 5 deals, and all of their deals are completely different. But on just 3 deals in particular, where the sellers stuck around for a meaningful period of time, what we found is that there's this hearts and minds type of situation at play here. We talk about various initiatives that, like, in their minds, they can see that it's right, but in their heart, it just feels too different as compared to what they have been doing for the past 10, 20, or 30 years. And ultimately, we've gotten to a point with all of the owners who have stuck around where our vision of what's required to be competitive, to grow, is different than the sellers. And that's the point where we, amicably part ways and really realize that, we've taken all that we can from that person. It's time to make that next step if we really want to achieve the full potential of the company and whatnot. Not to say that our way is right and theirs is wrong. Would never say that. It's just, as the new owner, we're the ones that are going to be around longer than the owner that recently sold. And so, our at some point, our ideas need to carry the way. Otherwise, why do we even buy it if we're just going to do everything the exact same? Now, I mean, again, I don't want to say it's all the time like that. I mean, we've definitely looked at deals where the company was on a great growth trajectory, and literally all we wanted to do is make sure we didn't get in the way of the management team, because they just had it locked down and they were doing an amazing job. That's what we prefer. I mean, that's like the dream scenario. Just unfortunately,
Right.
we don't always get the dream scenario.
Yeah, makes sense. Well, and I mean, you kind of have that responsibility to the investors as well, to be able to say, wait a minute, this is a clear path to take us to the next level, and really be the ones that see that. So when you're doing that, you'd mentioned that sometimes, and maybe it varies from business to business, but sometimes you've got a management team that's already in place. that can and take it to the next level. Do you ever bring in management from the outside, like a CEO or whoever it may be, to kind of help put your business plan together?
Oh, absolutely. I mean, we've been working on a deal in the QSR space, quick service restaurant space, and restaurants. You know, I would like to think that I could manage or run manufacturing type companies, a few service type companies, but restaurants, I feel like you need somebody with restaurant experience to run a restaurant. Maybe I'm wrong, but that's my personal viewpoint. And also, what you see in quick service restaurants is a lot of folks that once they're done, once they're ready to sell, they're done. They do not want to stick around. And so this
Right.
was this deal in particular for these two complementary reasons were why we felt we had to bring in not only a CEO, but really a core executive team to run these businesses post close. So that's not always the case. Really what we try and do is we try and work with the seller to craft a strategy that works best for them. So if they want to be more involved, we'll pull back on our involvement. Not certainly not recommend a new CEO or anything. However, if the seller wants to exit as soon as possible with no clear error apparent in the company, then we'll try to be helpful again in that situation and bring a CEO.
Okay. Interesting, for sure. And then what about, do you ever have owners that when you sell, they maybe carry the financing piece of it? I can imagine there'd be sometimes folks that don't necessarily want one large, capital gain where you'd be able to kind of spread some of that out. But you can tell me, are there scenarios where you see that?
Oh yeah, absolutely. I mean, we're very much in favor of those types of scenarios. We actually think it makes sense for the seller as well, for the cap gains reason that you mentioned, but also because a lot of times the sellers, I mean, where are they going to put that lump sum? I mean, obviously they have financial advisors and they can just put more of, they can just multiply their current investments in a mix of stocks and bonds and real estate and whatnot. But they know their business. They know whether or not they think it's going to be around for 3, 5, 10, 50 years. And a seller note or seller financing can be a very attractive asset class that is not available to them otherwise. And so for that reason and many others, yes, seller financing is often a piece of the capital structure that we would like to see.
Yeah, seems like it would make a lot of sense. How about are any of these businesses franchised businesses, like somebody that's maybe had several, particular of a franchise location, or are they all pretty well non-flag type businesses?
More so of the non-flagged type businesses. However, as of the past year or two, we've started to spend more time looking in the franchise space.
Okay. Yeah, because I've heard, at least with some, if you have a series of different ones, or you have maybe an owner that's grown large enough that they've got multiple locations, that might be something that would be attractive to a private equity firm. So.
Oh yeah, absolutely. And the multiple locations, it's risk diversification. You're in different markets. There's tangential opportunities and whatnot by being in these different markets. And also, what we found is that in some franchises, there's very little support at the franchisor level to help these franchisees learn how to run multiple units. And what we found is that the owner does a good job of running, 1, 2, 3, maybe as many as 10. But when you get to 20, 30, or 50, they just haven't had the coaching and experience required to be able to implement the processes and the procedures to run a 50-unit franchise operation effectively. And that's where we feel like the multi-unit experience that our team brings in this QSR deal, but there's multi-unit experience in other franchises as well. But those are the situations where we really feel like that can be a value add. And not only is it a value add from our perspective, it usually resonates pretty well with the sellers, because I wouldn't say that they're at wit's end sometimes, but it's getting, for a lot of sellers in this circumstance, it's getting to the point where the system isn't breaking, but their system is at its breaking point because their processes are more attuned to like a 3, 4, 5 unit type scenario as opposed to a 50 unit scenario.
Right. Okay. Huh. And what have you seen any change over the last, 2 years, from, obviously the markets have changed some, interest rates have gone up. But have you seen anything from the standpoint of being able to still buy these businesses, that, has either helped or maybe hurt that, at all?
Well, there was a period whenever there was less certainty about what interest rates would be doing, whether it was going to continue to rise or maybe stay flat or hopefully even decline. During that period of uncertainty, I would say that deals slowed down because lenders were getting cautious. They wanted to know what was going to happen to rates, and for that reason, again, the M&A pace of acquisitions and transactions slowed down considerably. Now we're in a period where most people feel like interest rates are relatively stable. I mean, I know some folks are still hoping for the Fed to reduce rates at least once this year. That might or might not happen, obviously. But again, there's less uncertainty, and I will say, in my view, uncertainty is one of the biggest deal killers there is, because it prevents the ability to predict what's going to happen. And once we got into a little bit more stable interest rate environment, the lenders were a little bit more flexible in looking at acquisitions like this, where they're doing cash flow loans, not 100% collateral backed loans and whatnot. I don't know if that answers your question or is taking it down the path you want, but that's what we have seen in the market.
Yeah. Okay. No, that makes a lot of sense. And then what, as far as, from an investor standpoint, and just whatever you're comfortable talking about, but somebody, how much does somebody typically invest with you? And you've talked a little bit about the time frame and the hold period, but what kind of returns? I know every deal is different, but just in general, what are you typically seeing out there?
Yeah, I mean, we're targeting no less than a 3x MOIC, multiple on invested capital, or if you prefer IRR, we would definitely want to be at least around the 20% mark. And
Okay.
I would tell you that all of our deals are on track to meet or exceed that metric.
Okay, great. Yeah, that's interesting, for sure. It's a neat business. It just neat to kind of take something that somebody has built to a certain point and be able to kind of, see how can we bring this up to the next level. So it seems like a pretty exciting thing to do. Anything
Yeah.
else, Nick, that we should know about, private equity, maybe specifically about, Four Pillars?
Well, what I would say is that I think there's a misconception about all private equity being the same. And just like in almost any industry, any type of work where it's relationship driven, I mean, no two private equity firms are the same. I mean, they might say they're operationally focused or this or that, but you really got to get to know the people that you're working with in private equity, because you know what? There are some folks out there that, quite frankly, I wouldn't want to work with. There are some folks out there that I would absolutely want to work with. It's the job of the business owner to at least dip their toes in the water to get to know private equity, because I'll be honest with you, there's some business owners that say, I do not want to sell to private equity, and it's because they've met a few folks or they've heard what it might be like to sell to private equity. And that's why I offer that advice. I mean, I know what it might have been like for your friend or your colleague that sold a business to a private equity firm. I can almost guarantee you that your experience is going to be different. I don't know if it's going to be better or worse, but it's on the business owner to really make the effort to figure out what flavor of private equity is going to work best for them. I mean, our flavor is entrepreneurism. It's driving growth from a like I said, a revenue standpoint, growing the employee base, trying to get to the point where you need to add square footage or need to add another facility or add an office in another city. There are others that are more spreadsheet focused and rely only on the management team and don't want to make a decision unless the number at the bottom of the spreadsheet is the right number. that's right for some people. It's not right for other people. So not a very concise answer for you, but again, just like in everything else, get to know the people that you work with, and ultimately, our view of success is being able to like the people that you ultimately work with. I think many of the business owners out there have achieved that level of success, and it's just can be a challenge to find that right person, but they're out there.
Yeah. Well, I like how, in your introduction, you talked a little bit about just being relationship first, and you think about these owners who have, built this business to a certain point. They've surrounded themselves with, employees that they, have, interest in them continuing to be able to operate it within the business. And so, I think that's where sometimes private equity, it scares people a little bit because it's like, okay, they're just going to cut people, they're going to cut expense, they're going to do this, this, and this. But I like the approach that you all take there at Four Pillars. So
yeah, I mean, the last thing that I just personally do not feel that cutting costs is the way to create long-term business health. Now, if you're a small business and you fly everyone on your team on a private jet for every single business trip, okay, that's the type of expense that we would like to cut. I mean, I know that's an exaggeration because who flies private at this size of company range? But again,
right.
I mean that's more of the mindset. I mean, if there's extravagant expenses, yeah, let's take a look at those. But in terms of people, it's hard to find people. I mean, if you have a team of 100, the last thing we want to do is cut 10 people because at some point we're going to have to replace those 10 people. As owners, we feel like it's our job to increase the level of revenue so that those 10 people are needed. I mean, again, it's crazy in my mind that you would ever try to reduce people in this labor environment. I mean, you just got to work harder to find a place for them in, because if you let them go, there's a good chance it's going to take you a lot more time and a lot more money to be able to replace them.
Yeah, for sure. For sure. And Nick, tell me, where do you see, what do you see for Four Pillars in the future? Anything different, or kind of rinse and repeat with what you're currently doing?
I would say for the next few years, largely rinse and repeat of what we have been doing. Ultimately, I think we will raise a fund just because we'll be able to deploy capital more quickly that way. But I'll be honest with you, to some degree, we're still establishing our track record. But more importantly, doing deals on a deal-by-deal basis, we've got a lot of flexibility. And I'm sure the desire for flexibility will resonate with your entrepreneurial audience out there, or the members of your audience that are entrepreneurs. And it's hard to give up that flexibility. So there's definitely some nice aspects to it as well.
Yeah, for sure. Well, and how can people find out more about you and Four Pillars?
Well, a lot of different resources. First, I do have a YouTube channel. My handle is at Nick for FOUR Pillars, PILLARS. There's of course our website, fourpillarsinvestors.com, with the four spelled out. And also, we've just recently published an ebook on how to sell your business to private equity. That's available at the website, add a / and then book, and it'll take you to a link to get that.
All right, fantastic. Well, this has been really cool, and I appreciate kind of your perspective and just hearing these different something new that I haven't had a whole lot of exposure to. But I've got two questions that I ask every guest, and so I'm going to ask you if that's all right. And the first one is really just any advice you might give somebody who's just starting out in their investment journey.
Well, what I would say is that you'll talk to some people and they'll say that if you work hard, you're going to be successful. If you talk to other people, they'll say, yeah, you got to work hard, but you also need a little bit of luck. And then what I would add to that is, yeah, you got to work hard. Yeah, you're going to have to get lucky sometimes, but you got to be comfortable with risk. If you're not willing to put your reputation, your money on the line, then that's fine. It's just there's going to be a ceiling to your overall earning potential, whether that's investments or your salary or whatever. And you just got to get comfortable with that.
Yeah, no, that's good advice for sure. How about Nick, any book recommendation? It doesn't necessarily have to be business related, but it certainly can be. Just something that's been impactful for you.
Oh, I would say there's a book that I was just talking about earlier today that I think is incredibly helpful. And I mean, I read this years ago and still think about the principles. And it's a book by David Cialdini, and it's called Science and the Art of Persuasion, or no, Influence, the Science and Art of Persuasion. I'm messing up that title, so I apologize. But check out Cialdini and Influence, and you should be able to get there. And it just really talks about how to be influential. I guess not to make the answer to this too long, but I used to read a lot of leadership books from a wide variety of topics. And what I realized that at the end of the day, as a leader, you have to influence and persuade people that your vision is the right one, and you got to get them to follow you. And that's why I found this book to be so insightful and so helpful.
Yeah, okay. I have not had that book recommendation, so I'll have to check that one out myself. So, well, Nick, this has been great. I appreciate it, and I think we'll call it a show.
Sounds good. Thanks a
All
lot.
right. Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.